So we've looked at the basics of the segregated fund. We looked at how the maturity guarantee works. We know that there is a death benefit guarantee. It's important to understand how that death benefit guarantee works. We'll look at a couple different scenarios. In the first scenario we'll look at, we're going to have, let's say, a contract value of $600. So the contract has fallen in value, and at that point, our annuitant dies. So this is based on the annuitant's death. This person is really roughly equivalent, as we saw in the last video, to the life insured in a life insurance contract. So we have the annuitant die with a contract value of $600. Now what happens, as with a life insurance contract, the beneficiary will receive those amounts. What the beneficiary is going to get here, though, is not $600. This is where the guarantee, once again, is quite useful. The beneficiary receives $750. We could argue here that the guarantee was worth $150. So we have an extra $150 that came from the fact that this is a segregated fund and it has these guarantees built in. Now, what if the contract had increased in value? So let's say we were up here at $1,800 and our annuitant dies. Once again, we have the same thing here. Our annuitant dies with this contract value up at $1,800. Well, once again, the beneficiary is going to receive $1,800. In this case, the guarantee is really not all that useful. The guarantee doesn't provide anything extra. In this sense, we can see that the guarantee, whether we're talking about maturity guarantee or death benefit guarantee, works like insurance. When is insurance useful? Insurance is useful when you've suffered a loss. This person has suffered no financial loss, and therefore we don't need insurance. The guarantee is meaningless. Here we have suffered a loss, but that loss is being made up with this $150 guarantee. Now, a couple of other characteristics of which we have to be aware with this amount received by our beneficiary. It's similar to, but not identical to, a life insurance benefit. It will bypass the claims of creditors. So creditors of that deceased annuitant cannot touch these amounts. It's creditor protected. And because we have a named beneficiary, it will bypass probate. Now, as we would expect, if we name the estate as beneficiary, or if we have an intestacy, then we will lose this characteristic, and the segregated fund death benefit will become subject to probate. But as long as you've named an actual beneficiary, a person as beneficiary, or even a corporation as beneficiary, which is not very common with segregated funds, then you're going to bypass probate. Ditto for creditor protection. You'll have that creditor protection as long as you've named a person as your beneficiary. Unlike a life insurance benefit, this is not necessarily a tax-free amount. There can be tax consequences, although not to the beneficiary of this benefit being paid. We'll talk about that in a later video. The beneficiary will have no tax to pay, but the annuitant could have tax consequences associated with this death benefit. So now we've gone through the basic features of segregated funds. We've looked at the maturity guarantee and the death benefit guarantee. And those are the two big features of segregated funds that really set it apart from a mutual fund. I do want to emphasize once again that you can, anywhere along the way, if you want your money out, you can get it. So you can grab those funds anywhere along the way here. You don't have to wait for a certain event to happen in order to get money out. It may not be wise to do so, because when you take your money out early, you'll bypass your guarantees. If you're in an up market, that doesn't matter. But if you're in a down market, that's probably not the wisest thing to do. Thanks very much. We'll have a few more videos looking at some of the various characteristics of segregated funds.